Alright. Hello everyone. Thank you for joining us. This is the Crypto Happy Hour, and tonight we are with Eisenberg, the humble Ponzi investor, and today we're going to have an informal conversation about Ponzis and yield farming. I don't know if Avi has anything he would like to say before we start.
Let's just go.
All right. So, Avi, do you mind telling us a bit about yourself and how you got into crypto?
Sure. I grew up in New York and lived there for a couple of years. I studied math in school. I spent a couple of years running an e-commerce business, and then at the beginning of this year, I was looking to invest some of my capital, and I was looking into crypto, and there are some really interesting investment opportunities here, and I've been doing that, mostly that ever since. Yeah.
That's cool. You know, I remember that in this summer, me and my brother were looking at some Binance Smart Chain projects, and he came across Panther Swap. To me, it just seemed like a ridiculous idea to put any money in it. But yeah, I'm not going to say you made money because I never know who's listening, although you can. Right? Although I can tell you that a lot of people recur to these yield farms to, you know, get yield on whatever they're investing or lending. So we haven't gone over what a yield farm is yet, but before we get started with that, would you mind telling us a bit about what you believe is a Ponzi?
Sure. The way I define Ponzi is any investment where you're putting in money to make a return, but the return structurally can only come from other people that are also putting in money to make their own return. This is not so scientific as a definition. I'm not trying to. There's like people give different definitions. That's how I look at it. You're putting money in, but the only way that you're going to make money is if other people also put money in, and then they have to lose money. Somewhere along the line, someone has to lose money. And I'm going to expand a bit with a couple of examples because sometimes the word Ponzi gets overused, and I have a very specific meaning in mind, and I want you to understand what that is. So one of the sort of typical examples of a Ponzi is Bernie Madoff, where he was taking in money, he had billions of dollars, and then he was paying out a return every year, and he would just make it up. And he would tell people I'm investing in stocks and making 10%, 12% a year, and but he wasn't making any money, but the money was just doing nothing. So the only way that anyone could make money in that is future people also put in money in order to invest, and then at some point somebody was left holding the bag, because it's not possible, obviously, for everybody to make money in a system that produces no value. That's a prototypical example. Now, some people say that all of crypto or stuff like NFTs is a Ponzi. I think that usage is a bit imprecise. The main difference I would draw between, let's say, Bitcoin or Ethereum is that there are indeed plenty of people that are buying Bitcoin in order to make money, and they can only make money if other people buy Bitcoin at a higher price. But the difference is that other people may buy for other reasons. There are many different reasons to buy Bitcoin other than to make money. You could have ideological beliefs that Bitcoin is a superior currency and you want to transact with it. There's all kinds of applications on Ethereum and other blockchains, and more generally, there's lots of reasons someone might want to buy other than strictly looking at making money from an investment standpoint. If the only way that anyone would ever buy cryptocurrency would be to make more money, then it would be accurate to call it Ponzi, at least under my definition, because then the only way that anyone makes money is from other people coming in, and at some point you run out of more people to come in. You cannot it's not possible, obviously, for everyone to make money in something like this. But when you have some people that are buying for non-monetary goals, like NFTs, there are lots of people that are buying for speculation. They put in money, they think they're going to make more money on it. But then there's some people that are buying for art, and that's sort of a more complicated motivation. Maybe some of them are trying to make money over the long term. But the broad point is that people are buying for some people, at least plausibly, at some point will buy for reasons not related to an investment return. It doesn't mean that those things are not overvalued, or that doesn't mean that they are overvalued. And many people will say that NFTs are overvalued and in a bubble, and they may be right, they may be wrong. But I'm just trying to draw the distinction and explain why I view that differently than a plain Ponzi, and so you understand what I mean by Ponzi when you notice it at all.
Awesome. You brought up a lot of good points, and I want to bring it back to the yield farm. Because obviously when people put their money in a yield farm, they're looking for that yield, that money, right? And although they're paying you in tokens, quote unquote, for whatever it is that you're doing, you might not necessarily be getting that monetary value back that you were expecting. So, yeah, can you please talk to us a little bit more about yield farms and how they relate to Ponzi's?
Sure. So I'm just first going to give a basic intro and definition of yield farming. Well, let me start with explaining what a liquidity provider and liquidity pool is. On Ethereum and a couple of other blockchains that are based on that, or other ones, you have decentralized exchanges where people can trade different tokens. And the way most of them work is you'll have a pair of two different tokens. So for example, you could have USDC, which represents $1, and then you'll have ETH, which is just the base currency of Ethereum. And somebody will put a bunch of USDC and a bunch of ETH into a pool under a smart contract, and then that smart contract will be ready will market make. It will be ready to buy Ethereum from anybody for a certain amount of USDC, and it will be ready to sell for a different amount. And there's a little bit of a spread because the smart contract automatically charges fees, usually about 30 basis points or 3%, as a fee. So if you would buy Ethereum and then immediately sell it back to the contract, you would give up something like 0.5% or 0.6 or so. So that's already, immediately you see there's one way to make yields there, which is just you're getting paid fees. You're putting up two different tokens, and people are buying one for the other, and as they trade back and forth and the price stays the same, then you just collect fees, and those fees can end up yielding a decent amount depending on how much volume there is, how much other people there are in the pool, a lot of different factors, and it's also constantly fluctuating. So one very simple low-risk yield strategy is to take different stable coins and put them in a pool against each other. And let's say you'll take DAI, D-A-I, which is a decentralized stable coin which is supposed to be worth always $1, and then you put them in a pool with USDC, then they'll always stay the same price, but there's people that want one instead of the other, and they need to trade, and they'll be willing to pay a little bit of a fee. So you're basically selling $1 for $1, and you're getting paid 0.1% or 0.2% every time there's a trade. And if you put money in there, you can make some kind of return. I don't know offhand what those returns are. Maybe it's 10% a year. Maybe it's more.
I think you get to choose if you make your own pool, right?
Yeah, if you make your own pool, you can set the fees at whatever you want. But there's the popular tokens all have their own pools already, which are pretty liquid. So if you're going to put something with high fees, nobody's going to use your pool, and it gets routed automatically to the one with the lowest fees, usually through a Uniswap or other decentralized exchanges. Anyway, so that's just the very basic. This is not really called yield farming. This is you make some kind of return just by putting two tokens in the pool and letting people trade against you. The thing is, when you have a setup like that, you actually lose money if the prices of the tokens change. Because you're effectively market making. You're offering to buy at, let's say, 99.5 cents and to sell at $1.50. So, I mean, a little bit smaller, let's say. And so if one of the tokens goes from $1 to $2, then people will buy from you that token at $1, and then they'll buy it at $1.05 and $1.10 up until they move the price to $1.99. And because you kept selling that at a price below the fair value, you ended up losing relative to if you would have just held those tokens outside the pool. That's called impermanent loss. It's a very important concept when providing liquidity and when yield farming. Whenever you own two tokens and you put them in a pool and the price of either one of them changes relative to the other, you will suffer impermanent loss. That means the value of the tokens once you take them out of the pool ends up being less than the value you would have had if you had the same two positions and you stayed out of the pool completely. Because you end up getting more of the token that went down in relative terms. And there's calculators online that can show you exactly how much impermanent loss there is for any given pool, any given weights of the pool, and how the tokens will fluctuate and so on. But that's important to understand. Now, in general, if you have two stable coins, there's not going to be impermanent loss because that ratio will never change. So a stable coin against a stable coin pool is basically the safest. If you have something like a stable coin against ETH, then if ETH goes up 10%, suddenly you're going to have something like 10% less ETH, and you'll have more dollars, and it's as if you sold ETH at every price point from the initial price till where it moves to. And then you end up with a lower value than you would have had otherwise, which could still be more than the initial value, because if ETH goes up, you held a lot of ETH. 50% of your collateral was in ETH, so that went up 10%, but then you lost some of it to impermanent loss. So, and there's, like I said, there's formulas and calculators you can figure out roughly how much you lose for different fluctuations and depending on what level of volatility. And that's providing liquidity. Yield farming is a step on top of that. That's where a lot of protocols will want to reward you for providing liquidity to their protocol. And often they will have a token, their random token for their random protocol. And if you provide liquidity, they will give you a constant stream of rewards in that token. So, and then you can claim, typically you're able to claim them whenever you want. They accumulate in every block if you want, or more realistically, you claim them once an hour or once a day. And you can sell that immediately whenever you claim. And this in general is called yield farming.
Awesome. I actually wanted to tie it back down to yield farming earlier when you were explaining the liquidity pools and the automated money makers, but it all worked out fine. So now I want to ask you, how do Ponzi schemes, or how does someone looking to make a Ponzi scheme relate his project or his attempt to a yield farm?
So there's been a lot of projects that effectively are mapped straight onto a Ponzi. Sometimes they're straight Ponzi, sometimes they're quasi-Ponzis and have other features and aspects. And they all have very similar structure, but sometimes they have extra moving parts in the background. The basic structure is the project issues their own token, and then they have liquidity pools for that token. Let's say they'll have that token versus USDC. And they want there to be a lot of liquidity for the token, so they'll incentivize people to join the pool with that token. Now, typically they also have a separate usually there's a few pools. Sometimes they'll have the token in single asset staking, where you just put the token there, you don't have any liquidity pool at all. It's just to put the token there and you lock it up. Sometimes they'll have a secondary token that's supposed to be a stable coin. But the main point the main feature of all of these schemes is that the only way or to get the yield, or one of the only ways, is to somehow buy their token. So, and doing that, first of all, helps everybody else that owns a token. So it directly benefits everybody that bought in before you. And it makes the token more valuable, so it makes the rewards more valuable. And that helps also attract more yield. So you typically have a cycle where all this happens, people buy in, it becomes even more attractive to buy in, and more people buy. And then at some point, it starts going the other way, because they're typically extremely inflationary, because they keep giving out rewards of their token to everybody that's providing liquidity to them. And those people are typically going to sell the token right away to lock in their rewards, and that pushes the price down. And every time someone comes in, they push the price up. Every time the people that are already there claim their rewards and sell it, that pushes the price down. At some point, it just can't grow fast enough, there's too much selling pressure, and the whole thing just collapses. Now that's the general framework. In practice, the more sophisticated ones add on a lot of epicycles to this, some to disguise it and make it look like it's more sustainable, and sometimes just to make it more complicated so that people don't really understand all the mechanisms. This is the basic structure, but there's a lot of stuff that gets built on top. So there's one a couple of months ago that you may have heard of called Iron Finance, which Mark Cuban got into and got rugged, and was complaining about, made headlines. That was a fun one. I was in that briefly, and I make money, so I am better than Mark Cuban, at least at that particular skill of making money on Ponzis. And I'm just going to give you the basic structure of how Iron Finance worked. They had an algo coin, which is a stable coin that's only partially backed. That was called Iron as the stable coin. And the way it worked is it was, let's say, backed by 80% USDC. So that means that the lowest it could really be worth is 80 cents. And that number just fluctuate based on, I'm not going to get into how the fluctuation works, that's just complex protocol math. But basically, so let's say 80% backed by USDC, and then 20% backed by nothing, but they didn't say it was nothing, but it was, the 20% was backed by the value of their other token that they were giving out in rewards called Titan. And now, like I said before, all the protocols will have incentivized pool for their other token. So Titan, they incentivized the Titan USDC pool, I think, or they might have had multiple pools, I don't remember the exact structure. But basically, because they incentivized that, there were millions of dollars in liquidity for Titan. So if you had a moderate amount of Titan, you were able to sell that immediately for relatively low slippage. So if you had $100,000 worth, you could sell that, you would move Titan up or down a couple of percentage points, not a huge amount. And then the way that you were able to the way that they backed the stablecoin was 80% was USDC. The other 20% they would pay in Titan converted. They would figure out how much Titan was worth 20 cents, and you could always redeem for that 20 cents worth. So that works as long as people are willing to buy Titan at the current price. Now, as long as more people are coming in, and Titan price doesn't fluctuate too much, this works perfectly fine. More people come in, the price goes up, Titan price goes up, there's more iron being minted, everything works. And then, at some point, more people want to exit than want to come in. And people get iron, the stablecoin, and they redeem it, and they get Titan and they sell it. But when you sell too fast, the price goes down, and you're not able to get as much. Because the way it technically worked was they would do it based on a weighted average of the last like 10 minutes price or something. So if the price went down too much on a 10-minute time period, you would you might redeem for 20 cents worth 10 minutes ago, but now it's worth 10 cents, and now all of a sudden you only got 90 cents worth of value for your stablecoin that was supposed to be worth $1. People would wait for the 10 minutes update, and then again, and there was a period where I was sitting there, and every 10 minutes it would drop 10% immediately. It was literally like that, because there were people sitting and waiting to get out, fleeing for the doors, and they would redeem, and 10 minutes later another batch would redeem, and so on. Everybody was trying to get their value. And in the end, when you have a system like that, it's a zero-sum game. It's not physically possible for everybody to get out at par. Anyway, the famous headlines, if you remember, were that the price of Titan went from $60 to nothing in a day. And that's what happened. The fur went down, it crashed a little, and that triggered everybody trying to run for the exits. And they couldn't all do that at once, and it went to zero. And I just want to make a note, this is the kind of deep analysis and understanding you need to run with these Ponzis. You need to understand what happens when everybody runs. Who is getting out first, who is getting out last, who is losing. And yeah, how I'm describing it, I'm not giving you the full picture. I did a bit more work and more modeling to see how it worked. This is the kind of understanding you need to try to understand where all the moving parts are, what happens when you buy, what happens when you sell. For example, there were fees on minting and redeeming. You paid a little bit in a fee when you minted, and you paid a bit of a fee to redeem. And so those sort of put limits on how far it was able to move from the peg of $1 before it was profitable to buy and redeem, or vice versa. And there was a 10-minute average pricing thing, and then it dropped, and it ended up dropping too quickly. And the whole thing went poof, and then in the end it was worth about 74 cents because the backing amount had fluctuated to 74 cents. Now, one thing I would point out is that if you understood how the system worked, you could have, and I in fact did, know that the max loss on a liquidity providing strategy was a certain amount, and I would put it at about 14–15%. Because if you had held iron and USDC, you would have 50% of your money in iron and 50% in USDC. Now, if iron goes down 25%, you have 50% of your money here, so you lose about half of that, about 12.5%. Then it ends up a little bit more, up to like 14%, because of impermanent loss, which I mentioned before. Now, at the time, like the day that it collapsed, I think the yield was around 1.5 to 2% a day, which is not necessarily that great. I mean, this is the math I did, and if you did that, you had to expect it to last either 10 days or so before it collapsed, just to break even, or you had to expect to be able to get out before it collapsed and be able to get out suffering that 14% loss. But because the max loss was capped in this way, because it was mostly backed by USDC, it made it safe to put in relatively larger amounts of money, because you're only really risking 14% of it. And then you're making 1–2% a day, and even if you got there for a few days and then you left, and if you managed to get out before it dropped, you would still be up like 5%, which is still pretty good. If your max loss at any time is 14%, then it's still not that bad.
Before you move on, because I know you're talking about what you look for, like in these projects. I wanted to ask you just that. What is it that you look for in these yield farms that share these vague or if not very precise resemblances with traditional Madoff Ponzi schemes?
So I'm looking at anything that can produce yield. And sometimes I'm also looking at arbitrages. So I mentioned this very briefly before, but basically when you had the iron finance, when the coin went above, like when the coin was worth $1.01, you were able to mint it by buying Titan minting and then selling it for 101, and you can lock in on arbitrage completely risk-free profit. And sometimes you can make good amounts of money that way. So this week there was an iron finance clone called Tower Finance, which I jumped into a few days ago. It lasted about 2 days before it collapsed. And I managed to get out completely like an hour before the collapse, so that was very good timing on my part. But even the collapse wasn't too bad. So there, the max loss on the collapse would have been something like 4%, because it was 92% backed by USDC. The Tower token, which is the same as the iron token before. The Tower was supposed to be worth $1, and Ivory was supposed to just free floating. It could be whatever price it was. So that was so when Tower was over $1, you're able to buy Ivory and mint Tower and sell it. And when it was under $1, you're able to buy it and redeem immediately, and then sell the Ivory you got. And I did that several times. At one point, I was actually able to capture something like a 4 or 5% spread on a decent amount of money. And then, like the first day, the ARBs were completely free, and basically nobody was doing them. Like the second day, somebody started botting them, and I actually saw one transaction from a bot that made about $8,800 in one transaction, just ARBing completely risk-free. That is pretty interesting if you know how to bot, or if you're there on the first day. In some of these things, you can ARB manually. I was able to ARB manually the first day, and I actually was able to ARB during the collapse. I was able to buy, because people were dumping Tower at like 92 cents, when you were able to redeem it for 92 plus some Ivory. And if you could buy at 92, then you would probably sell the Ivory like at least half of, even if it goes down 50% from the weighted price, you would still get out something like 95 cents. Yeah, I was able to make a couple of, I think like 1 to 2%. And one ARB I was actually able to carry it out during the collapse. This was like a day ago. But it was much riskier to do during the collapse. I think I lost money when I tried to ARB during the iron finance collapse. So now we're super congested, and my transactions just weren't going through. That is a risk. I don't recommend doing ARBing during when some are very volatile, because if you need multiple transactions to go through, then there's no guarantee that the prices stay the same after the first transaction goes through. That is a bit of a risk. Also, definitely don't recommend doing ARBing until you really understand what's going on and try it with small amounts of money first and so on. Probably should have added like a whole list of disclaimers at the beginning. You're the lawyer here, so can you add the disclaimers now?
Yeah, let's
Hey everyone, thank you for joining us. I see some new people have come along. You're welcome to sit down wherever you want. We are having an educational discussion. There's no financial advice being given, no legal advice. You consult your own attorneys and your own investment advisors. That's it, that's everything. So, you're obviously someone who's not afraid of risk. You're getting in the midst of a collapse in one of these projects that you openly call a Ponzi. What would you tell someone who is not as experienced as you, who is perhaps a little more risk averse, and specifically a newbie, someone who just came in and is looking at getting into yield farming, and he might lose a boatload of money if he doesn't know X or Y. So, yeah, I don't know if you left off on that, but if we can pick it up there.
Sure. So one thing is definitely go slowly. Put in small amounts of money that you can afford to lose. Don't jump after things. Don't have FOMO. There's always more opportunities out there. If you don't fully understand something, it took me 6 months to figure out how everything worked, and to get comfortable to the point where somebody sends me a message and they say, oh, here's this cool Ponzi that's launching, should go jump in, and I look at it and say, hey, yeah, it's good, and I just withdrew a bunch of money, I shipped it over, and I jump in. I ape in, as the term is. But I do not recommend that. for the tower finance one, I was comfortable with that in part because it was a clone of iron finance, and I had done some really deep analysis of iron, and so I knew there was like a few variables that they changed, but basically at the core was the same. So I understood how the mechanics worked, and what would happen, and why it would go up and why it would collapse afterwards. But it takes time to get that kind of comfortable with it, and there's a lot of uncertainty. Like, I wasn't sure how long it would last. Nobody knows this kind of stuff. I saw the first day it was yielding about 5–10% a day, and my math was then it was something like a 3% max loss, and there was a no-brainer for me because you only needed to last less than a day to make back the most you could lose if it collapses, and I did that, and I did some arbs, and in like 2 days I was up like 10%, and then I got out and before it collapsed. But even if it had collapsed, I would have lost something like 3%, I think. So even if I had slept it off and woke up today and said, "Oh, this is collapsing, there's no money left here, let's get out," I would have been up like 7% instead of 10%. So it's not that bad. But a lot of the money here is being very early and being able to get in the first day. Or the first, well, this particular one was, the curve was set up that it grows very fast and then shrinks very fast. Some of them are more drawn out. And the ones that are more drawn out typically have lower rewards, but there's also stuff that's lower risk. So you need to have a good understanding of where the actual downsides are. Aside from the downside of stuff losing pegs, sometimes you actually have to own the underlying token, and then you have a risk of going to zero. There's always some risk of getting hacked or of getting rugged. There's some background risk of that. I would recommend, if you're just getting started, take a relatively small amount of money and just try these out. Just try everything you see with like $10. You can't do that on Ethereum because the gas fees are too high, but if you're on BSC or Matic, which is where the Iron Finance another one was on, or most of the other sidechains by now have extremely low fees. Matic is like a penny a transaction or so, and some of the other ones maybe a couple of cents. So at there, just take $100 and go into all of these and figure out where it works and see what works and understand the mechanics. And when you've been through a few crashes and you start getting more of a feeling, read through the documents, and like eventually you get an idea of how everything moves. Sometimes the best money is not necessarily participating, but in doing an arbitrage and doing more complicated plays. So I don't know if you've read the blog post that I shared, but there I talked about a different one called Polyquity, which is a clone of Liquidity. So they actually have a stablecoin that does work because the stablecoin is over-collateralized by Matic. But separately, they had a token that was incentivizing providing liquidity to that stablecoin, and people were buying that token. And I would say that's not 100% Ponzi, it's quasi-Ponzi because there's some utility there in the end because it enables people to borrow against their Matic. And so there's plausibly some level of use, but then there's also Ponzi dynamics where the reason why a lot of people are buying the stablecoin is in order to stake it in the liquidity pool and to get the rewards of their other token. Anyway, I didn't participate in that yield farm. What I did do is I minted the stablecoin and I would sell it whenever it would go up over a certain percentage. And it was trading at some point at like 107. And I was able to mint and sell it and then just wait for it to go back to like 102 and I would close it out. And I did that for like the first week when it launched. And I made a good amount. I made like a couple of percent on my stack in a week, which is pretty good in most worlds. With fairly low risk because I understood all the moving parts of that. But it was a bit of a complicated thing because you had to monitor the price of Matic because you were effectively borrowing the coin against your Matic. So You have to borrow Matic and then borrow that against Matic and monitor the price and rebalance whenever it moves too much. So it was a bit of a headache for a week. So that's just sort of an example of very often on these new protocols, there's other either arb opportunities or trading opportunities that are not necessarily related to the main thing. What you want to do is look at the protocol, understand how it works, and once you've looked at 2 or 3, I'm not going to say they're all the same, but there's like 3 or 4 basic structures, and then everything else is all the same as one of those 3 or 4. There's algo coins, there's over-collateralized coins, there's straight-up Ponzis that they just charge you money to go in, and then they pay it back. So let's pay some of it back with their token. And then there's exchanges and other stuff. And the core mechanics of incentivizing a token pool is basically all the same across everything, and just the numbers are different. But that's just so like standardized at this point. Is you have one token with the main pool and the main token, and you have another pool that's some kind of stable, and those are fairly easy to get once you understand. Once you've seen a few. And so I was saying, try to understand them, and sometimes just using the protocol and using the main pools is the best play. Sometimes there are sort of exotic plays like arbitrage, or like shorting the stable coin when it's over some price, or things like that are sort of guaranteed to make money, but you might have to wait a bit, so you might be tricky in execution. I like that kind of thing. Or you could just go into the pools. I have found, so I said before, if you have a stable coin against a stable coin, it's considered very safe. But that's only stuff that's going to keep the peg. Sometimes you'll have a pool that's just incentivizing you to put in liquidity for 2 real stable coins, like DAI versus USDC. I have seen pools on that will pay you 20-30% annualized. And those are pretty decent to go into, and you make money. It's just that the token doesn't last forever, so you want to constantly sell the rewards. As sort of more yield farming, it's usually those are not really that Ponzi-ish. They're probably technically Ponzi's because the only way you make money is if other people buy the underlying token, which is no real reason for them to do in most cases. Those ones are much lower risk and much lower rewards. A lot of times you can tell which ones are higher risk and which ones are lower risk just by the yields. The lower risk stuff almost always has much lower yields. And so like the reason why I was so interested in jumping into tower finance is because the first day the yields were much higher than the risk. It was 3,000% APR, so that was something like 5-10% a day. If it was like a few 100%, and with the risk of collapsing at any point, then that's sort of about normal. When it's 3,000, I knew that it was good. It's not going to collapse when the rate is that high. It ended up collapsing around when the rate drops to about 1,000. A bit after that, which is actually earlier than iron finance on the same curve. I think iron finance was at like 300 to 500% on the day that it collapsed. People are jumping out of these kinds of things earlier because they learn. So there's always some people that lose money on these things being too late. So my general philosophy is you want to be early and you want to get out early. And it's always better to get out too early than too late. So I started jumping out like a few hours before the collapse, and then I really dropped a bunch, and I said, okay, that's it, this is gonna collapse soon, and I jumped out, and it ended up happening like an hour or 2 later. So that was lucky on my part. But not everything is as exciting as that. Not everything just collapses outright. Sometimes the iron finance clones have a much faster collapse because of the way that the stable coin is tied to the other coin. There's lots of other projects that just have a token which is going to go down gradually, and the yield will just keep going down, and it starts at the yield as 100%, and then it goes to 90, and then 80. And there's no real rush if you're holding regular tokens, no real rush to get out. If you're just holding stable coins. So there's lots of different varieties of yield farming projects out there, and just try to wrap your head around few of them and see where the risks are and try it out with small amounts of money, and you'll get smarter and you'll get rugged a few times and you'll figure out what to do.
I think if anybody that's been in the crypto space long enough has definitely gotten rugged or knows somebody that's gotten rugged. Avi, I think we got to the end of the questions I had written down. I want to invite the audience to start thinking about their questions before we wrap up. If you have a question, you can just come up here and I'll lend you the mic so you can ask. And while they have time to think about their question, if they want to ask one, yesterday while we were talking about this conversation we were going to have, you brought up smart contracts and audits. And you said that it was important, perhaps not to dominate them, but to get in the weeds of them and really try to understand them. Can you talk a little bit more about that? Because you did talk about technical aspects and getting familiar with the protocol and the 4 different general types of Ponzi or yield farms that there are. But yeah, can you share with us that? Because at least me personally, I'm looking into like, you know, how do I read a contract? How do I write it? What the heck's an audit? When you told me that you could read audit reports, I was surprised. So please.
Thank you for that. And yeah, I forgot to mention that. So most good projects these days have an audit. And sometimes it's a crappy audit. Sometimes it's there's so many firms that will just take your money and slap an approved thing on it, and they'll do some like static analysis that's not really worth much. But a very good way to start understanding where some of these things go wrong is to read the audit reports. They're usually not that long, and they tell you, well, we looked at this part and it's copied from that contract, and here's this sort of minor flaws. And I mean, the major flaws are almost always fixed before the thing goes live, but still reading them will give you an idea of what kinds of things can go wrong from a technical level. Also good is reading previous exploits. If you want to avoid getting hacked, look at rekt.news, that's rekt.news. They have very good postmortems of the big hacks and exploits. And you read that and you get an idea of the kind of things that go wrong. But it's very unlikely that you'll actually, I mean, it's good to get an idea of how the different parts move, but it's not likely that you'll find an exploit, just because finding exploits was hard. If it was easy, there would be a lot more exploits. So, like, you won't necessarily, don't expect that you'll figure out how something can get exploited. You could figure out how something can get rugged. That's much more common, and for there you want to look at who's able to withdraw from the contract, who the owner of the contract is, and a lot of projects will use a time lock, which means that a time lock contract owns the main contract, and so that's the only one that's able to send the admin transactions, and that contract doesn't put a delay. It requires you, let's say, you have to put the transaction in, and then 12 hours later you're able to execute it. So that makes it much safer because the project owner cannot withdraw the money, which would be a rug, without a significant amount of notice. And everyone else could pull their money if they saw that. So you want to look at that and see if there's any address that's given permission to withdraw without such a lock. And you also want to look at how long the time lock is. Those are useful to know. But another thing is if you have other people that you can network with that are all researching the same thing, like people can share different red flags or get an idea of what to look at. Like, you're not going to go from zero to being able to do super in-depth research and that quickly, but you can master one aspect. Like, one person can be in charge of like just finding new stuff as soon as they launch, and then analyzing to see how they're growing. And I mean, because besides for the due diligence part, you also want to make sure it's a good bet, and you want it to be something that's currently growing. You don't want to get it on the downtrend. Usually, you want something that still has a decent amount of runway ahead of it. There's just a lot of things you want to look at. It is definitely useful to be able to understand how the smart contracts work. just on the basic level. You can find lots of resources online for that, and then just read through. If you know how to program at all, you're not going to be able to program Solidity that quickly, but you can read through the contracts. They're not that hard to read, and you can sort of trace through how the code is supposed to work. And you read through a few of them again. They all copy code from each other. They're all clones, and they just change a few parts that do the important stuff. But it is a bit useful if you trace through, because sometimes the documents aren't so clear on exactly how something is calculated, and you can read the contract and figure it out. That's also definitely a useful skill to have.
All right, well, sorry about that, people. Does anybody have a question? Because, yes, Dave, please, can you come over here for the mic, please? Yeah, sorry about that, no. You don't have to show your face if you don't want to, you can just answer.
I just wanted to know what's an average cost to do an audit on a contract. Just a range. Just a range.
Thank you. Thank you for your question, Dave.
I'm not sure. I've never had to pay to do an audit. I think it's in like the several $1,000 range, if I had to guess offhand, possibly more. Probably if you want a good one, you're probably paying $10,000 plus. But that's just sort of off the cuff, and I'm just completely guessing just based on what I know about what the salaries are of the people that are qualified to do this. If you just want to pay, you can pay $500 to get an automated one. It will say it's audited from some sites that will just print out it's audited, and because they just didn't find like the very super obvious issues. That'll work for some people, but if you want to do a real project, you probably want to get from the top firms.
I could audit a contract for you, but I don't know if you want me auditing anything, especially a smart contract. That was a bad joke. You can laugh or not laugh. Anyways, if there aren't any more questions, I'd like to thank Avi for joining us tonight, and I would like to invite you guys to follow either one or both of Avi's Substacks on the message that I included on the discussion board for this event. There, you can follow Avi's work. And if not, I think Avi can give a shout out to how you can contact her. So, thank you, Avi, and please let us know how we can talk to you.
Yeah, I was also going to say you can also follow me on Twitter. Do you have the link there, or I'll send you the link. You can just message me there. It's fine. Or on Facebook. Put a Discord, because I'm also pretty active there. I'll give you all the links and you can post them later, I guess.
Perfect. No, I'll comment them on the live video.
Okay, great.
Yeah, I'll comment them on the live video. So, without further ado, thank you everybody for coming. A round of applause for Avi, and we'll catch you next time. Adios.